Inside of this video, I'm going to show you one simple level you can add on to your chart to make your trades more high probability. So what is that, right? Well, it's the weekly open. Okay, so if you don't know what the weekly open is, it's basically the start of the weekly candle. Okay, meaning this level here, this level here, this level here, this level here, right? So I'm actually going to show you why and how this level improves the probability of your trades. Let's just mark it on first in this little diagram. So based on the idea of a power of three, okay, and if you actually haven't gone ahead and watched my previous video on daily bias, okay, the easiest daily bias method in the world, go ahead and watch that. It's absolutely amazing, and I'm going to use it in this video to go ahead and forecast the expansion of the next candle. So in a power of three, right, we look for the weekly candle to start by running against us, so a protraction in the opposite range, or in the opposite direction, and then we like to see an expansion in the direction that we're looking for, right? So if we're bullish, we want to see price go lower before going higher, and vice versa, right? I'm showing you a bullish example here because this trade example that I've cherry picked is a bullish example. So pretty much, right, any trade in the vicinity of this area is mega high probability. Okay, so any trade below the weekly open or in and around it, maybe at it, maybe a little bit higher, is going to be a great area for entry. Why is that? Because if you look to position yourself inside of the weekly candle, right, at a low portion of it, then you're going to be able to catch this entire weekly range, right? As opposed to, let's say you were looking to long at the top of the weekly candle, you have less room for error. Okay, let me actually put this a bit higher. So for example, if you got in somewhere like this, you might be holding, thinking, yeah, I'm on side, weekly supposed to expand to the upside, and then you end up getting wrecked by the close of the candle, which is going to go ahead and retrace. So if you're inside of the weekly open area, right, as a whole, and you could measure this, you could just say, oh, within 10, 20 pips or 30 pips, depending on sort of, I'd say the average weekly range of the pair or the asset that you're trading, then you can go ahead and basically just position yourself inside of this area. So another key thing to mention is that when we do go ahead and retrace, right, you don't want to try and catch the absolute bottom. You actually want to allow for the consolidation or accumulation to happen, allow the manipulation to occur, and then you're looking for simply just to get on side with that weekly expansion of the candle. Now, you might be a day trader and you might say to me, well, why would I need to be concerning myself with the weekly expansion if I'm a day trader? Okay, and this is where you might be missing something. If you know where the weekly direction is, you'll know where the daily candles are likely to print, right? So if you know that the daily candles are going to print higher because of the weekly open and the weekly direction, then you've pretty much got an easy bias on your hands. Okay, so let me show you this cherry picked example and exactly how you can go ahead, formulate the bias using the techniques from the prior video, and basically how you can get on side with the weekly expansion. So first of all, we'll analyze order flow. We can clearly see that we've tapped this weekly FVG right here and we've rejected away aggressively. Another thing, if we look at previous month's low, okay, and previous month's high, we clearly look for price to go ahead and tag previous month's high right at the top video here. Sorry, at the top of the chart here. So in terms of the next weekly candle, right, what could we anticipate just on this time frame alone? I would be leaning bullish, right? But now we want a bit more data, we want a bit more information. So let's actually go ahead and tackle the daily as well. So let me just move this in. Let me just move this in, and we can expand this here. So on the daily, what do we understand here? Well, we have a couple things. One, we've had a sweep on liquidity, so I understand that smart money is in. We understand that order pairing has happened here, which means that below this area, which would have had willing sellers, smart money would have paired orders here, meaning we know that smart money is on side looking to distribute their positions. Where they're going to look to distribute their positions at old highs. Okay, very simple. So smart money always looks to pair or get in at an area of liquidity and to distribute and at another area of liquidity, right, which are always just going to be swing highs, right? Very, very, very simple. With the daily as well, if we understand the program, or just order flow as well in general, we can see how we've actually disrespected bearish arrays. So that's inverting them, potentially making them into inversion gaps, and we're also building bullish arrays and having large range candles to the upside. So again, pointing to the idea that we're up. So look how already we've formulated a bias using the weekly and the daily, and now simply put, all you need to do is wait for the weekly to essentially start forming, build the accumulation, and then start running. Okay, so with the weekly expansion, if you're a beginner, I'd say leave Monday out. Okay, that was awful. I'd say leave Monday out. Okay, you do not need to trade Mondays. Allow Monday to be a forecast in which you're looking to see what price is trying to do. Okay, because Monday's really going to do two things. It's either just going to start expanding higher, right, and then you're just going to look to trade Tuesday, continuing the expansion, or Monday is going to create that opening range for you, right, where you can then go ahead, look for price to um, build sort of that consolidation range. Tuesday to go ahead and wick out, or even Wednesday, and then the expansion higher. And then simply put, once you know where that weekly open is, this weekly open level, after you allow Monday to trade, you're just looking to get on side somewhere in and around this level, some sort of retracement, could be OT, could be FEG, could be order block, and then to see the expansion higher. Okay, so very easy in terms of exactly what you're looking for. Now let's let Monday play out, and also we can get access to the weekly open. So you can see in this example, what did Monday do? Monday created a very indecisive candle. Right, so let's mark on its high and its low. On the lower time frame, we'll have a bit more information on what it looks like. But another key thing it done was it formed a higher time frame PD array. Okay, so this daily BISC. So Monday's created that opening range for us. Let's have a look if we can get some manipulation lower, or if we do manipulate lower, and then where we go from this. With this set example, I'm just going to stay on the 1 hour. I will show the intraday afterwards and a couple of things about that, but I won't really go into depth with it. So we've had Monday's range, right? And now you can see on the hourly how Monday was a consolidation. So if we think about the idea of the power of three, the accumulation, manipulation, distribution, right? If you just allow the distribution and the manipulation to occur, right, it's very easy to get on side with the distribution. Most people are hitting SL here and here, right? If you just were patient, allowed price to go ahead and formulate the first two phases and then just look to trade the distribution, your win rate will already go up massively from that. So let's just see what happened on the hourly here. So we've gone ahead, reached lower, right? So we've done the accumulation. We look like we've done the manipulation phase now. Okay, let's see what happens now. So price rejects that level, right? And remember here, we've actually taken out liquidity, so very, very clean. Or what do we get here? We get CSD, right? So price has clearly switched from what? Sell program to buy program. Now that price has gone ahead and done the manipulation potentially, right, of the week. Okay, what do we need to see? All we need is some sort of retracement to then look to expand price to the upside. Okay, very, 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 very simple. So where would we anticipate retracement? Well, we sort of have this breaker. Okay, whether you want to say it's this candle or this candle doesn't really make much of a difference. We also have an FEG and another FEG. Okay, so simply put, you could just trade the retracement, right, into fair value, stop either at the liquidity or being more sort of conservative at the low of the candle that created the FEG. Target 1 being this high and target 2 being that previous month's high up there. Okay, so let's just see actually what happens from here. So we go ahead, we tap the FEG, and price runs away very nicely, right? Let me just show you as well on the intraday time frame here. So you can, and this is what I would be doing. I would then be analyzing the cycles as well. So for example, we have Asia here. We have a London protraction cycle. And as I've taught in many other videos, we have that pre-New York retracement, and then New York expands to the upside, right? So again, you could use the cycles to get in here on a smaller time frame, like the 50-minute or the 5-minute. So you're essentially trading an intraday move and then being able to capitalize on it via a weekly expansion. So it's basically the best of both worlds, really. You're getting in on a smaller time frame or nothing crazy, but you're able to trade it on an intraday perspective, but being able to hold based on a weekly expansion. Okay. So, like I said here, I would use the daily cycles personally, but that's more beyond the scope of this set video. But you literally can go ahead and analyze this and extract a lot from that as well. So let's just go back to the hourly. All right, I'm going to keep this super simple. So now, okay, because we'd entered around the weekly open, right, you'll know that cool. This can really, you can really hold this all the way till, let's say, up here or up here. You know you have range to go, and because you have range, it means that basically price is going to mess around less in this area, right? Another thing to think about is at this manipulation area, typically, right, price wants to spend as least time as possible, because when price takes liquidity, you can go ahead and backtest this yourself. But when price goes ahead and reaches for liquidity, normally you want to see that sort of V-shaped recovery, because smart money doesn't want to spend too much time down in this area, right? Typically, they want to be in, and then you want to see the market sort of push higher and then slowly sort of filling fair value and pushing aggressively to the upside. Okay, a lot of the time they want as least people sort of getting in at these levels as possible, so they're going to basically spend less time there. So anyway, let's say we're up here now. So for example, let's see, there's a more fair value to enter, right? You could still enter on this one. It's still fairly within the weekly open price. So let's just see what happens here. So we take the high out, play around. Okay, so we actually go ahead and form another market structure shift, and we form another FEG here. So for example, this might act as a breakaway gap now, and we might just run away from here. Okay, so there you go. We tap it very narrowly. You can see that right there. And go higher, form another FEG. Right, and this is the beauty of being on side, right, on the weekly, is that order flow should hold very clean and very nicely. Okay, so there you go. We expand higher from here. You can see we're tapping this in again, come a bit lower. We'll see it tap now. Order block right here. And what do you do from here? We go ahead and we reach higher. Okay, so if I just break this down on the daily now, we have what, Monday, which has gone ahead and created the opening range consolidation. We then had Tuesday, went ahead and pierced the low and then traded higher. We also then have Wednesday going higher, Thursday going higher, and Friday going higher. So literally the best entry in this example, right, would have been in and around this level. Now this example doesn't really illustrate well how you could get caught up in these high levels, because gold was really that aggressive. But logically speaking, you can understand how getting in at this manipulation area is going to be better than getting in, for example, all the way up here and hoping for price to overextend. Okay, because typically, right, this one it didn't redo it, but typically you are going to get that rounding off of the week somewhere at a high, right? So we don't want to be chasing price towards the end of the week. We'd rather look to get in at the start of the week and trade this. So this would then be following a weekly cycle profile that I like to call a classic expansion, which is where Tuesday had gone ahead and created the low. Other days can create the low in that expansion as well, but Tuesday is basically the best day to do it. So pretty much that's exactly how you want to go ahead and use this. Literally go ahead, back to some of your examples. Don't just believe me when I say, oh, this works and blah blah blah. Like literally go ahead, check out all your trades and see which ones align with the weekly open. Maybe you'll notice that majority of your winners were around the weekly opening price, and you can use that going forward, right? So anyways, hope you guys enjoyed this, and I'll see you in the next one.